oil and gas. To talk more about the entire space, we have Jal Irani, who is the Executive Director of Nuvama Institutional Equities, who is joining in. Jal, hi, good to see you on the show. Well, since we've put behind Q4, I wanted to start this conversation with the entire OMC space. Q4, the EBITDA, was quite robust for a lot of these oil marketing companies. BPCL, for example, reported a better than expected profit. And a lot of these stocks, BPCL, HPCL, IOC, have done very well with double-digit growth on a year-to-date basis in terms of their stock performance. What are you envisaging in terms of further upside on these stocks and triggers?
Okay, so I'll answer that question, but at the outset, I thought we were discussing CGDs. So let me answer that in any case, and then we can move on to the CGD space. Essentially, the OMCs last year earned a record level of refining margins, but significantly large negative marketing margins. Now, this year with crude oil prices coming down fairly sharply, and also refining and diesel crack spreads, i.e. the refining margin for diesel and petrol coming down significantly. So therefore, this year, refining margins are actually suboptimal levels, but the retail margins are extremely high. So just to put that into context, refining margins were as high as $20 a barrel last year. Normalized levels should be maybe about $6. At the moment, there are $4. While on the other hand, diesel retail margins were in negative 10 rupees a litre. Now they are more than positive 10 rupees a litre. Now, as a balance between the two, retail is a bigger business than refining, and therefore net they should be doing better this year than they did last year.
Jal, hi, good afternoon and thanks for joining in. On the city gas distribution companies, what is your call? What does the next, say, 6 to 12 months look like in terms of earnings? And what are your top picks here?
So what I'd say is three things for the city gas distribution space. We have done a very detailed total cost of operation analysis of the CNG business versus EVs, because that's the burning question. And a very detailed analysis suggests that CNG buses are 26% cheaper than the EV variant, and in terms of cars are 22% cheaper than the EV variant. So while the two will coexist, both are growing very rapidly. In fact, the growth in CNG, the CNG vehicle additions per month has actually more than doubled in the last 2 years. So the point is that despite the threat, so-called perceived threat of EVs, actually CNG growth has doubled in the last 3 years, and hence EVs are not a threat. The second thing is that in our assumptions, we've taken very modest volume growth of 7 to 8% versus historic volume growth of 6 to 14% for these companies, and actually sub-inflationary EBITDA per SCM increase in margins of 3 to 5%. So fairly conservative numbers. And the third point related to that is, despite actually being very conservative, these companies are actually presenting compelling value and very high ROEs. They have a 20% ROE, and rising, in fact, very sustainable net free cash flows, net cash balance sheets, and the stocks are, the likes of Mahanagar Gas, for example, is only at a 10 times price to earnings ratio. So the third point is that actually, despite assuming a very modest growth as versus historic levels, the stocks are also very compelling valuations. So three perspectives. One is they're competitive versus EVs. The growth is actually going to be reasonable. And third is that the valuations are very compelling.
Okay. So your top picks within this space would be?
Or order of preference is Mahanagar Gas, followed by Gujarat Gas, and finally IGL in that pecking order. MGL presents a better risk return, a more favorable risk return proposition than IGL, which is a comparable play. Because firstly, Mahanagar Gas is now demonstrating that it's willing to grow again, and therefore its growth is going to be potentially equivalent to IGL, if not maybe even higher going forward. And you are getting MGL for just 10 times price to earnings ratio versus IGL at 16 times price to earnings ratio going forward. So that's the reason we prefer MGL as our top pick versus IGL.
Okay, so MGL is your top pick compared to IGL. Got that. I wanted your thoughts also on Reliance Industries. I know this chat was primarily on city gas distribution companies, but since we're talking oil and gas, we can't leave out Reliance Industries from the discussion. Agreed that the earnings in the quarter gone by were pretty decent. Across all verticals, things look good. But if you map the last 6 months or even 1 year, right, I mean, the stock has done nothing. A year ago, it was at 2,500. Today, it's at 2,540. Is there any trigger that can take Reliance above this range that it's been trading at?
So, what I'd recommend is you all should stick to the stocks that you're going to discuss, because there are also compliance issues behind this. But
sure,
in any case, I will answer that. I mean, look, Reliance is a company where earnings continuously grow. It's a function of PR expansion or contraction. What had happened 2 years back is that the market took up geo and retail valuations to ridiculously high values. And therefore, one is seeing a derating in the geo and retail valuations versus actually its core business, which is gas and refining and petrochemicals, is doing very well. So actually, it's one balancing out versus the other. That is what is actually happening to the stock price.
Okay. Well, Jal, just getting back to your calls on MGL, Gujarat Gas, as well as IGL, I wanted to know that, yes, there are compelling valuations. It's at around 10 times FY25 PE when it comes to MGL as well as GGL and IGL. All of them are trading at very compelling valuations. But what is the downside risk to your analysis, to your target price, to your earnings forecast?
Just a clarification, Mahanagar Gas is at 10 times PR FY25, not at 5 times. See, the concern has been that these companies would actually, the growth would be impaired going forward, especially, I mean, in the context of EVs growing. So that is actually a key concern. Now, the simple point here is that EVs are meant to compete with petrol and diesel vehicles first, okay? And CNG vehicles are versus petrol, for example, at half the cost, basically. So the economics of a CNG works out half the cost of petrol. And therefore, if EVs are competing versus petrol and CNG is roughly half the cost of petrol, therefore, CNG has got to be cheaper than EV vehicles, even intuitively, beyond actually the total cost of operation calculation that we've done. And in fact, going forward, as you are aware that FAME benefits are going to go away from 2024 for EVs. And without that even going away, EV sales growth has started tapering off already in the last couple of months. So the biggest concern has been that volume growth of CNG vehicles will be affected. If anything, as I mentioned, actually the CNG volume growth has doubled for the last 3 years and continues growing. Versus EVs is also growing, but that growth is tapering off. So it's not as big a concern as the market is actually reflecting.
Okay, all right, Jal. Always a pleasure speaking with you. Thank you very much for joining in and talking to us. So that's the view coming in on the entire oil and gas, as well as specifically the CGD space or city gas distribution companies. We need to take